Hey everyone, ready to talk dividends?
Always. Who doesn't love a little passive income?
Right. And that's what we're diving into today, specifically those high-yield dividend stocks. We're taking inspiration from Amjad Izhar's recent blog post. He breaks down 12 companies that caught his eye.
And I think what's great about his approach is that he doesn't just chase the highest yields. He digs into the fundamentals, looking at the companies, their financials, all that. Because a high yield doesn't mean much if the company isn't built to last, right?
Exactly. So it's about finding that sweet spot of attractive payouts and long-term stability. And Amjad kicks things off with his all-stars, Verizon, Pfizer, and Enbridge. Those yields, especially Verizon and Enbridge, they're nothing to sneeze at. Over 6%. That's impressive.
It is. But as always, the why is crucial. Let's take Verizon, for example. They pretty much dominate the U.S. wireless market, which is a powerful position to be in, obviously.
Yeah, I mean, everyone and their dog has a cell phone these days.
Exactly. But what I find interesting is their commitment to 5G. That's where they're putting a lot of their energy, and it makes sense. It's the future of connectivity.
It's not just about faster downloads anymore, is it?
Nope. 5G is the foundation for all those cool technologies we keep hearing about, the Internet of Things, self-driving cars. Verizon is making a big bet that they'll be leading the charge, and that kind of forward thinking is essential for any company that wants to keep those dividends flowing for years to come.
Makes sense. So they're not just riding the wave, they're trying to build the next one. I like that.
Exactly. Plus, they've got that history of financial discipline. So even when things get rough in the market, and they always do, they've got that stability to weather the storm.
Okay, so Verizon is looking strong. What about Pfizer? Everyone knows them, but pharmaceuticals can be a bit volatile. I mean, look at what happened with the vaccine.
True, but Pfizer has a few aces up its sleeve. First, their product portfolio is massive. Hundreds of drugs. That diversification is huge because it spreads their risk.
So if one drug or one area isn't doing well, it's not the end of the world.
Right. And look, they've had some dips recently, especially with the vaccine sales winding down. But they've got this incredible track record of increasing dividends for like 15 years straight. They're committed to their shareholders. They're in it for the long haul.
That consistency is definitely reassuring. Now, Enbridge. They're an energy infrastructure company, which, honestly, pipelines don't exactly scream growth to me these days.
It's interesting you say that because Enbridge gets it. They're not just about pipelines anymore. They've been diversifying big time. They're into gas transmission and distribution, and get this, renewables.
Wow, really? They're getting in on the renewable energy game.
Oh, yeah. They're positioning themselves for the future of energy, and I think that's smart. But here's the thing that makes them particularly appealing for income investors: the bulk of their earnings. They come from those long-term contracted businesses, super stable, super predictable. So even if energy prices are going crazy, they're still raking it in.
So they've got that nice combination of adapting to the changing energy landscape while still providing that rock-solid income stream that dividend investors love. It's a win-win. But, Amjad, he didn't stop there. He's got another category of companies: second chance and future potential. Now, that sounds intriguing and maybe a little risky.
Intriguing is spot on. We're talking about companies that might have stumbled a bit alongside those that could be the next big dividend payers. But that's a story for after the break. So this next group of companies, it's a real mixed bag. You've got some familiar names that have, well, let's just say they've had their fair share of challenges,
Yeah, a little bit of a roller coaster ride for some of them.
to put it mild.
Amjad calls this category second chance and future potential. And looking at the list, AT&T, Palantir Technologies, Amazon, I can see why. Let's start with AT&T. I mean, they're iconic, but they've also had some missteps lately, right?
Oh, yeah. Remember those big acquisitions they made? DirecTV, Time Warner.
Vaguely, I feel like those were a big deal at the time.
They were going all in on media and entertainment, and it backfired. Those deals left them with a mountain of debt, and they had to make some tough choices.
Like cutting their dividend.
Exactly. Not a popular move, especially for income investors who relied on those payouts. But here's the thing. They've been working hard to turn things around. They've been slimming down, focusing on their core telecom business, and, crucially, investing heavily in 5G.
So they're trying to modernize, get back to basics.
Precisely. They're betting big on 5G and fiber optic expansion, which makes sense in a world that's becoming increasingly reliant on lightning-fast connectivity.
So is it working? Are they on the road to recovery?
Signs are promising. Their stock price has been climbing, and they're still offering a decent dividend, over 5%, according to Amjad. But whether they can regain that investor confidence, That remains to be seen. It's a bit of a gamble.
High risk, high reward, right. Now, Palantir and Amazon, those are interesting choices. They're not exactly known for paying dividends, are they?
Not yet, no. And that's where the future potential part comes in. See, both companies are pouring money into AI, artificial intelligence.
And AI, that's the next big thing. Everyone's talking about it.
For good reason. It's poised to revolutionize, well, pretty much everything. And both Palantir and Amazon are betting big that they'll be at the forefront of that revolution. Plus, let's not forget, they're both sitting on mountains of cash.
So the thinking is, if AI takes off like everyone's predicting, those profits could translate into some pretty hefty dividends down the line.
Exactly. Of course, there's no guarantee. They could easily decide to reinvest those profits back into the business, keep that growth going. It's a long game for sure.
It seems like AT&T is more for those who want some immediate income, even with the risk, while Palantir and Amazon are for those who are comfortable, playing the long game, hoping for those big future payouts. Now, switching gears a bit, Amjad also dives into REITs, real estate investment trusts, and he highlights three in particular: Federal Realty Investment Trust, Essex Property Trust, and Realty Income. I know REITs can be great for dividends, but what makes these three stand out?
Well, each one has its own sort of specialty. Take Federal Realty, for example. They're all about stability, long-term, reliable income. They've got this incredible streak going, 50 years of increasing their dividend payments every single year.
Wow, 50 years. That's unheard of.
It's pretty remarkable. They're what's known as a dividend king. And they've achieved that by building a really diversified portfolio, shopping centers, retail spaces, even some residential properties. So they're not overly reliant on any one sector, which helps them weather economic ups and downs.
Diversification, always a good strategy. Now, what about Essex Property Trust? What's their niche?
Location, location, location. They focus on those high-demand, high-rent markets. Think San Francisco, Los Angeles, places where owning a home is crazy expensive, so renting is the only option for a lot of people. And that strong demand, well, it translates into pretty consistent rental income for Essex.
Makes sense. High demand, high rents, high profits. And lastly, we've got Realty Income. What's their claim to fame?
Realty Income is another dividend king, but they've got a unique twist. They pay dividends monthly. Yep, you heard that right, monthly.
Okay, now that's appealing. Who doesn't love a little extra cash flow every month? Then how do they manage that? What's their secret sauce?
They primarily own freestanding retail properties, and they structure their leases in a very specific way, triple net leases.
Triple net leases. Okay, you've definitely piqued my curiosity now. What on earth are those?
So with a triple net lease, the tenant takes on a lot more responsibility for the property's expenses. On top of rent, they're also covering things like property taxes, insurance, even maintenance.
So it shifts a lot of the costs and, I imagine, the headaches away from Realty Income and onto the tenant.
Exactly. And in exchange for taking on those responsibilities, tenants typically get slightly lower rent payments. But for Realty Income, it creates this incredibly predictable, consistent income stream that they can then pass on to investors as those lovely monthly dividends.
That's a pretty sweet deal for them. And for investors who love that regular cash flow. But it seems like we've only scratched the surface of the REIT world. Amjad didn't stop there, did he? More REITs. Amjad's really taking us deep into this world.
He is. He had three more on his list, each with a slightly different angle. Simon Property Group, Ventus Inc., and Public Storage.
Okay, lay it on me. What makes these REITs stand out?
Well, let's start with Simon Property Group. They're all about that high-end retail experience. Think those upscale malls, the outlet centers with those big-name brands.
Yeah, I can picture it. They always draw a crowd.
They do. And they're offering a pretty enticing dividend yield right now. But I'd be remiss if I didn't mention the elephant in the room, the whole online shopping trend.
Yeah, that's been tough on traditional retail, although I gotta say I still love a good outlet mall trip. Okay, so Simon Property Group, they're facing some challenges. What about Ventus Inc.? I'm not as familiar with them.
Ventus is interesting because they're tapping into a major demographic shift, the aging population. They specialize in senior housing and healthcare facilities. And with the baby boomer generation entering retirement, well, that demand is only going to go up.
Smart move. They're getting ahead of the curve. Okay, last but not least, Public Storage. I feel like their business model is pretty self-explanatory.
It is. They're the kings of self-storage. And here's the beauty of it. Their business, it's pretty darn resilient. Think of it. People need extra space no matter what's happening in the economy. They move, they downsize, their families grow. You can't just download extra square footage.
That's so true. And I imagine that consistent demand translates into pretty stable earnings for Public Storage.
You got it. They've got strong financials, a history of dividend growth. They're definitely one to consider.
Wow.
We've covered a lot of ground today. From those all-star dividend payers to these fascinating REITs, Amjad's insights have given us a lot to digest.
They really have. And you know what else impressed me? He didn't just throw out these stock picks and call it a day. He included this whole bibliography on investing in his blog post. Talk about going the extra mile.
It shows you he's not just about giving quick tips. He's about empowering investors to do their own research, to really understand the companies and the strategies behind those dividend checks.
And that's what it's all about, right? Learning, exploring, making those informed decisions that align with our own financial goals. Amjad's analysis is a fantastic starting point, but now it's up to us to keep digging, to keep asking those questions.
Exactly. What other resources are out there? What other deep dives can we take? That's the exciting part. The journey of investing is all about continuous learning.
Well said. And on that note, we'll wrap up this deep dive into the world of high-yield dividend stocks. Big thanks to Amjad Izhar for the inspiration. Make sure you check out his blog post. We'll have the link for you in the show notes. And until next time, happy investing, everyone.